Welcome to the data dawning, where the data speaks. We listen. It's time to unlock the numbers and decode the story. Okay, let's unpack this. We're diving deep today into understanding market structure, specifically in Bitcoin,
Right.
and we're doing it by looking at something pretty specific. Liquidation data. Our source material today gives us these really interesting visual tools, Bitcoin liquidation heat maps.
Yeah, these heat maps, they're designed to help forecast potential market moves by showing where forced position closures, liquidations, might cluster.
It really feels like getting a bit of an inside look at the leveraged trading side of things.
Exactly. And what's really useful here is how these heat maps take some pretty complex behind-the-scenes stuff and make it visually, well, kind of intuitive.
Mm-hmm.
Based on the descriptions we have, a liquidation heat map isn't just like a pretty chart. It's pulling together all that margin call data.
That's when positions get force closed, right?
Wow.
Lack of collateral.
Precisely. It aggregates that from various exchanges across different leverage levels traders are using, and the whole point is to highlight specific price levels where there's a high concentration of these potential forced closures.
And you can literally see that concentration on the map itself, each horizontal line, each band.
Right.
That's a Bitcoin price level.
Right?
And the color in that band tells you basically how dense the predicted liquidations are right there. The source says purple is low concentration.
Yeah. Less activity predicted there.
While that bright yellow, that signals a really high density, lots of vulnerable positions stacked up. Makes sense why they call it a heat map. It shows where things could get hot.
That's a good way to put it. It's a snapshot of where leveraged traders could be forced out if the price hit certain points.
So, okay, why should you, our listener, care where these liquidations are stacking up? The source material points to a couple of really practical uses for this.
Mm-hmm.
First, these high density yellow areas can act like magnet zones for the price.
Ah, the magnet effect.
Yeah, like if price heads towards a yellow band, just triggering a few liquidations can start a domino effect, right? Forcing more closures, pulling the price even further. It can kind of feed on itself.
That's the cascade idea, yes. But there's another side to it, too.
Which is?
Well, paradoxically, these same dense areas can sometimes mark out latent support or resistance levels.
How does that work?
Because where you have a big cluster of potential liquidations, you often have significant underlying liquidity. Think big players, institutions maybe. They might step in right at those levels.
Ah, okay. To absorb the forced selling or buying.
Exactly. They can place large orders without instantly moving the price too much because of that concentrated liquidity from the liquidations happening. So sometimes you see a bounce or a reversal right at those points.
So they're not just magnets. They can be like battlegrounds too.
Could be. Depends on the context.
This is where it gets really interesting because we have actual data. Let's zero in on that first heat map image. This one shows the recent data, right? The time axis goes up to around 11.15.
That's the one. And as you look at it, you can see the price range it covers, giving us the current sort of lay of the land for Bitcoin's leveraged market.
Okay, and what about that scale on the left? The vertical axis.
Right. Pay close attention to that. That's the liquidation leverage value. It's basically quantifying the potential size of the leveraged positions at risk at each price level.
And on this current map, the max value shown there is, what is it, $133.8 million.
Yep, 133.8 NEMAs is the peak predicted leverage density shown on this particular map scale. Now, scan across for those bright yellow bands. Those are the critical zones we're talking about.
Okay, looking closely now. Yeah, there are some definite hotspots. I'm seeing a pretty clear cluster forming around the $108,000 level.
Mm-hmm. 108K.
Then moving up, okay, another noticeable yellow band near $110,000. And wow, right above that, around $111,000, it looks quite dense too.
Very strong concentration there, yes.
And it seems like there's more heat even higher up, above 112K, towards the top of what's shown.
That's right. The density picks up again in those higher ranges shown on the chart. So those levels you pointed out, roughly 108K, 110K, 111K, and those zones higher up, that's where the current data suggests large pools of leveraged money are most vulnerable right now.
Those are the price points that could trigger, well, significant reactions if they get hit.
Precisely.
Hey, if you're finding this breakdown valuable, do drop a like and share it. So connecting this back to what we said earlier, these dense zones around 108, 110, 111K and higher, these are those potential magnet areas the source mentioned.
Could be.
And also where we might see significant support or resistance battles play out because of that underlying liquidity concentration.
Now, to really grasp what this current picture means, We need a bit of context. That's why the second heat map is useful.
Hmm.
Our source gives us one from an earlier time period.
Right, the one labeled as previous episode data in the notes, with the time axis starting earlier, around 08.20. Let's pull that up.
Okay, look at the difference.
Yep.
First, check that liquidation leverage scale on the left again. On this older map.
Whoa. Okay, that max value is way higher. It says $216.2 million.
Exactly. Compare that to the $133.8 million on the current map we just looked at.
That's a massive difference. The total potential leverage showing up as dense clusters is much lower now.
It really is. Let's just quickly quantify that. It dropped from $216.2 million down to $133.8 million.
Okay, so that's a decrease of, carry the one, $82.4 million.
$82.4 million less in predicted peak liquidation density shown. And percentage-wise, that's a drop of about 38.1% compared to that earlier snapshot.
Wow, so nearly 40%, more than a third of that peak vulnerable leverage seems to have just vanished from the map, or at least dispersed.
Or been liquidated or closed out, yes. It suggests a pretty substantial deleveraging happened between these 2 points in time reflected in the data. A lot of that, maybe let's call it excess leverage, seems to have been cleared.
Okay, that's a huge change in the amount, but what about where the leverage is? Did the locations change too?
Absolutely, and that's arguably even more important. The location of those dense yellow zones has shifted quite dramatically.
Okay, let's look back at that previous map, the older one. Where were the hotspots then?
If you look closely at that second image, the previous data, the most prominent yellow bands were actually clustered lower down. There was a really strong, dense zone right around the $105,000 level.
Ah, yeah, I see that. Very bright yellow, around 105K. There were other clusters higher up too, leading towards 111K, but maybe not quite as intense as that 105K band.
Seems that way from the visuals, yes.
Yeah.
Now, flip back to the current map again.
Okay, current map.
See? That dense cluster that was so obvious around $105,000 in the previous data, it's largely gone, or much, much weaker now.
Yeah, it's definitely less intense. The heat has moved.
Exactly. The current heat map shows the highest concentrations have clearly shifted upwards. Just like we identified earlier now, heavily focused around $108,000, $110,000, $111,000, and those higher levels.
So the price levels where the market's leverage positions are most at risk, they've literally jumped up the chart by thousands of dollars. It's not just a minor tweak. The whole landscape of these potential trigger points looks different. The lower areas seem kind of cleaned up leverage-wise.
And based on the source's logic, this tells us a couple of important things. One, it strongly suggests that either price moved down and triggered those liquidations near 105K.
Or traders just got out of those positions.
Right, they closed them. And two, it implies that new leverage positions have been opened at higher prices, or maybe positions that survived the lower moves are now carrying their risk profile into these higher zones.
So the market's potential liquidity magnets, the spot's likely to see big reactions. They've been redrawn completely, moved higher, following where the vulnerable money is now sitting.
It really shifts the focus for anyone watching these levels, doesn't it? Those older zones around 105K seem maybe less immediately relevant from this specific liquidation perspective now, while these new higher zones like 108, 111K become the critical points to watch.
By the way, for more updates like this, make sure to follow us on Twitter at Snippet Labs.
So the implication here is that the market seems to have, let's say, digested or cleared out a big chunk of leverage that was sitting lower down. That reduces the potential fuel for downward cascades originating from those specific lower levels, at least for now. But it seems to have rebuilt or shifted that vulnerability upwards. It's created new potential trigger points, new areas of interest at these higher prices. So the price action around 108K, 110K, 111K becomes really, really important to monitor based on this data.
Now, there's an important reminder, a caveat, in our source material we should mention.
Yes, absolutely.
It notes that these heat maps, that they forecast where liquidations might begin. They show the potential ignition point.
Right, not necessarily where a price move will end, or how far a cascade might actually run if one starts.
And also that the densities, the colors, they're relative within that specific map at that specific time. Yellow is dense compared to purple on that chart.
That's a crucial distinction. These maps don't predict the future trend, like prices going up or prices going down. What they do is highlight areas of, let's call it structural vulnerability, that price might interact with in significant ways.
So knowing where these big clusters are gives you a critical piece of the puzzle, right? Insight into potential market dynamics at those specific levels.
Exactly. It's about understanding the potential pressure points.
And if you want more deep dives like this, definitely subscribe to the Snippet Labs YouTube channel.
Okay, so let's try to bring this all together. We've taken a look at Bitcoin's market structure using these liquidation heat maps. We saw how they visualize where leverage positions might be forced to close.
Hmm. Mm.
The key takeaways from the data we looked at are, well, twofold, really. First, the total predicted liquidation leverage shown seems to have dropped substantially compared to the earlier period, down by over $82 million, which is around a 38% reduction. Significant deleveraging indicated there.
Right, a big drop in total risk shown.
And second, maybe more importantly, the location of the most prominent liquidation zones, those critical price clusters, has shifted upwards. While the older map showed high density around $105,000,
Yeah, that's cleared out now, mostly.
the current map highlights significant clusters now sitting higher. We saw them around $108,000, $110,000, $111,000, and even stretching higher. So this upward shift in the liquidity magnets gives you, the listener, these specific higher price zones to watch really closely for potential market interactions. That's where the leverage seems most concentrated and vulnerable now.
Found this useful. We'd appreciate it if you drop a like and share. Okay, so that brings us to our final thought for you to, mull over based purely on this heat map analysis we've done today.
Okay.
Given that these big clusters of vulnerable leverage have moved, and they're now mostly sitting at these higher levels, 108K, 110K, 111K, and plus, think about what kind of market move would be needed now. Specifically, which direction does price need to go to start triggering liquidations at these new higher clusters?
Interesting angle.
And then consider how triggering the liquidations at, say, the 108K level might potentially create momentum, that cascade effect that could impact the clusters sitting just above it, like at 110K or 111K. Or maybe even affect levels below if it causes wider instability. It really does redraw the map of potential volatility, doesn't it?
It certainly changes the pressure points to watch. Definitely something to think about.
Remember to subscribe to the Snippet Labs YouTube channel.
And follow us on Twitter at Snippet Labs for ongoing updates.
Markets move fast, pinpoint your next profit window, and seize the moment.